Hello, everyone, and welcome to this episode of 22 Minutes. I am Jason Bates, bringing you the lender side of things, and my colleague, my confidant, my realtor in crime, whatever, Stefan Gotten.
Right.
He's going to bring us the real
Right.
estate. There you go. Yeah, he's going to bring us the realtor side of things. And then together, we hope to not only entertain you, but bring you valuable content that you can actually use when you're looking to buy, sell, refinance, or invest in property. So that's what this show is all about. We do this Monday through Friday, 9 a.m. Arizona time. So if you want to watch the live show, head over to our Facebook page at 22 Minutes, and you can check us out in full HD right there. And
Right.
while you're there, like the page too. Tell your friends and family about us.
If you want to have a good laugh, go to one of our first episodes.
I don't know.
Right.
That's a little scary. That might turn people off, man.
Oh yeah, yeah. Well,
We've come a long way since the first episodes, no question about it. So um, that's a good thing.
yeah.
Okay, so we always do a tweet quote of the day. Let's get to that because we got some good information. At least I think it's good information, and I think a lot of people might find it very interesting. Some people might find it boring because we're talking numbers, that kind of stuff, but it's super important when you're making the biggest investment of your life. So we felt it was good to kind of bring this to the forefront. So we'll go through that. But first, let's get to today's tweet quote of the day. Cue it up. All right, what is today, Stefan?
It is hashtag Throwback Thursday.
Yeah, well, on a national level, today is actually National French Fry
Oh,
Day.
it's right there in front of me. All I had to do is read. I didn't know
Yeah,
that.
there you go.
What is today? It's somebody's birthday on Facebook. I saw, but it's
There you
also
go.
National French Fry Day.
It's always somebody's birthday on Facebook, it seems like.
Do you think this table of French fry lovers? Do you think they're going to be able to eat all those French fries?
I don't know. I don't know. That's a lot of fries, and when they get cold, they're not as good. What's your favorite fry?
Well, Chick-fil-A fry. It's pretty good. That's the one we
Chick-fil-A.
like.
Yeah, they're good. Yeah, they're good. They're absolutely good. Faux show, they're good. I like the
Waffle. Good.
McDonald's fries.
Yeah,
McDonald's
they're
fries
good.
are good. Burger
Has
Kings are
nothing.
okay.
Usually, your tweet quote of the day has something to do with the show or something to do with home buying. But today, no, French fries.
Well, go out there and eat some fries while you're shopping for a home. How about that spin?
Okay.
Get them in your
Is that
car.
July?
Good,
Is that
good.
July 13th? Can you go back to it, or is it too late? Because I thought it was like July 17th.
Today's
Friday.
the 13th.
Today, is the 13th of the July is always the Friday.
Uh, y- oh, yeah, that says tag on Monday. Yeah, but no, it's National French Fry. It's trending all over on
Okay,
Twitter.
good.
So I don't know why that says
All right.
Monday, July 17th. Um, I don't know why it says that, but
Last year or the year before or something.
yeah, yeah,
Well, July 17th is well. Okay. Anyway,
yeah. Anyway, I don't know. It's trending on Twitter. So I thought, well, okay, National French Fry Day. I'll play your game. Let's do it. Hey, let's get into today's subject matter, and this is something that very few people, especially in the mortgage industry, which is unfortunate. Um, I was just having a conversation with my son actually last night about some of these big players, Quicken Loans, Loan Depot, that sort of thing. They hire some people. They don't really know kind of their craft, if you will. They don't really
right.
follow interest rates. They just kind of blurt it out. They get told what to do, and that's kind of the script they follow, and that's it. And that doesn't really do a service to the consumer. At the end of the day, the consumer, all he cares about is interest rates, but I think there's more to it in understanding interest rates, especially for the professions who are in this, or professionals
Yeah.
who are in this industry, like yourself and myself. So this is what this episode is all about, because I do get asked from time to time, what what influences interest rates? Where are they going? What is your prediction? Where do you think they're going? Should I lock today? Should I not lock? That sort of thing. So I'm going to put this up here and let's merge it over. And I got this PowerPoint presentation here. So let's,
Okay.
let's kind of get into it here.
Let's see
So
what this.
this is. Can you can see this? Okay.
Oh yeah, I'm just trying to see what it is. I gotcha.
Okay.
Percentage
So
up and down.
up and down. So I'm a subscriber to MBS Highway. They keep me abreast as to what's happening on the secondary market. Janet Yellen spoke today. The market kind of is in favor of some of the things she more or less didn't say, which was that she's not committed to raising interest rates in September. There's some talk now that raising interest rates may not even happen for the rest of this year, or they may sneak it in at the end of December. So I thought this the timing on this couldn't be better, right? So this is the first time I've ever done this, so please bear with me on this. I do have a. Let me go. Let me pull up the next slide here because I think the one of the more important things to kind of understand here is how a bond actually works. Because
So the bond
bonds,
bond is the base of interest rates.
yes, yes,
Correct.
yes. This is where companies borrow against to determine interest rates, and so hey, there's
Mama
Mama
Sugar.
Mama Shuckers here. Hey, thanks for joining us. Appreciate it.
Our
Um,
North Dakota native.
our North Dakota native, absolutely. Okay, so how does a bond work? So I want to put up the example here of the perfect loan, right? The no risk, no it's just the perfect loan, no brainer type of loan, right? $100,000 mortgage. We'll keep the numbers pretty simple here. 10% LTV. No second liens, 800 FICO, 5 million in post-closing liquidity, meaning they have a lot of money. The borrower has a lot of money after closing. 5% back end ratio, so they're not, overextending themselves at all. And we use here, just for practical purposes here, a 4% interest rate at simple interest, which all mortgage loans are simple interest loans. What does that equate to in income per year for banks? And that's $4,000. So that gives us the kind of base as to how this will all kind of play out here for us. So if
Okay.
I bring up the next part here, so knowing how the bonds work and how interest rates work, if rates went to 8%, how much is this asset worth? Now, this asset really is worth what it's paying out right now, right? And a lot of people think that, well, the asset is worth the $100,000. Well, to
That's what I
banks
would
and
have said.
things, yeah, it's not worth $100,000. It's worth what it's paying. It's kind of like commercial lending. Commercial lending, if you know anything about commercial lending, the property is worth the income it generates. It's not like
Okay.
residential, where residential is the value of the actual structure and demand and so on and so forth. Where on income producing properties, like commercial properties, it's worth the income it produces. So
Okay.
that's kind of how this kind of plays out here. So now, if interest rates went to 8% instead of 4%, how much would this same investment yield, or what would the investment need to be in order to yield the same $4,000? And I'll put
50K
this.
loan. Is it that
Let me
simple, or am
take
I
this.
wrong?
No, you are. You're right. You're right. So it's $50,000, right? So see how that math kind of works? It kind of goes backwards, right? 8% simple interest, $4,000 on $50,000 investment.
Okay.
Okay.
Loan amount. So the other thing is, we said it's 100K mortgage, which means they picked it up for about 110K because you put 10% down, right? 90% loan to value.
Well, it's actually, he put 90% down, so it's actually the property's worth much more. I was making the
Oh,
example, yeah, making the example of this is a no risk, no brainer. Who
mm,
wouldn't invest in this in person? The risk
okay.
is not, because there's layers of risk involved in interest rates too. So I just kind of dummied it
I
down
get it now.
to, yeah, make it no risk.
The 10% LTV, and we should probably go back to that slide then. That way everybody's on the same page.
Yeah, I don't know how to go back on the
Okay. Then
PowerPoint.
no worries. I should have said it 2 minutes earlier.
Sorry, I don't know how to go
My
back
fault.
on that.
Promise you go like this to go back.
Just rewind
Yeah.
the tape. Right? All right. So now I want to kind of take it the other direction here too, right? We still got the
Oh, there it
same,
is. There it is.
yeah.
Okay. But before we get into the meat of it, 10% loan to value. That means the mortgage is 100,000. So I'm borrowing 100,000, but that's only 10% of the loan to value, meaning that the property is $1 million property.
Right.
I have an $800 FICO score. My interest rate's at 4%, so it's 4,000 a year plus. I mean, that's the simple interest. So
Yeah.
4,000 a year is the simple interest.
That's
Going
from the
person.
bank's perspective. What is this? What is this loan? This investment in
Yep.
this individual? What is it yielding me? What is it paying
Yep.
us? Right.
Yep.
Okay. So now, let's take it the opposite direction. If interest rates went to 2%, how much would that asset be worth? Remember before on the previous slide, at 8%, the asset then became worth $50,000, right? In order to yield the same
So
amount.
this would be 200,000.
Correct. Correct. So you can see that as interest rates actually go down, the value of the asset or the loan itself, the mortgage-backed security, if you will, goes up. Okay, on
Right.
the secondary market. So it doesn't take as much to generate the same $4,000 in income. Okay. Now this is important because we are now coming out of a stage here of negative interest loans, right?
You say it doesn't take as much, but it takes twice as much to get to
Well, it
that
takes twice,
4,000.
yeah, twice as much as
Yeah. So
on the value of the asset, right? If interest rates rise, yields on the bonds and prices fall. This is where I've always said, as if you look here, I don't know if my cursor is going to show up here, but as yields go, and if you want to watch the interest rate, this is a little tip I'll give everyone. If you want to watch the interest rates and what's happening with interest rates, watch the 10-year yield or 10-year bond, the yield on that bond. As that yield goes, so do interest rates. Okay, so if the yield is going up on the 10-year bond, then interest rates tend to go up. Now, some people say, okay, well, 10-year yield, if it ticks up just one tick, does that mean interest rates go up? No, it doesn't. If it goes up 6 basis points, 0.06 basis points, we generally have a midday rate change. Okay, so for the consumer out there, if you want to watch the 10-year bond, used to be 30-year bonds. When I first got in the industry, 30-year bonds, but the government did away with 30-year bonds because and the reason for the 10-year bond is because the life expectancy of most mortgages is between 5 and 7 years, maybe 8 years now, right? So mortgage companies will invest in this bond and securitize against this bond because they know it's probably either going to refinance or sell or pay off or whatever within 10 years. Therefore, there's no need to tie it up for 30 years
let's go back
security.
in a time machine. 30 years ago, interest rates were like 17%, 15%.
Yeah.
So imagine if you were to get that 30-year bond in 1987,
Right.
and what you'd get. I mean, you'd make a lot of money on it.
Right. So just keep an eye on that's the little tip. If you're watching rates, whatever, if you're thinking about refinancing, whatever, watch that 10-year bond. All right. So now this next slide kind of puts a perspective on the global, because when I talk to clients all the time about interest rates, it's not just here locally. I mean, we're kind of in our own little bubble here in Phoenix, but interest rates are a global thing, and so I've got some kind of demonstrations here.
Thanks,
Because
Brexit.
yeah, I know, Brexit. Thanks, Brexit. UK pound has dropped. So this is a little outdated. So this is, put this in perspective here for us. But Brexit was kind of a recent, economic event, if you will, that affected interest rates quite substantially. So I thought this would be appropriate. So when England did the Brexit and exited the euro and is now getting their own currency and things together, their pound dropped because they weren't part of a bigger collaboration, if you will. So that means their exports got cheaper because the value of their dollar, the pound, dropped, but the imports that they needed to import for their country got more expensive, right? So an example here is just a laptop. So a laptop, and I had it here at 1,000 or 100.
100,000 yen.
Yeah, 100,000 yen. In September, I know these are outdated a little bit, but again, this is all for purposes of when this
Theory.
Brexit actually happened. Yeah, £1 equaled 200 yen at that time. Today, Well, that would mean that that laptop then would cost £500 to import
Okay.
into the UK. And today, the pound is worth 130, or £1 equals 130 yen, excuse me.
Yep.
Therefore, in today's standard, that laptop would now be £770. That's a rise of 54%. That's inflation. Okay? So inflation can affect bonds. And so how does that actually work? So,
I kind of wanted to go over that with the numbers there, but
oh, sorry. Did I go too fast?
you're not allowing me to share the 2 cents on the slides. It's all right. It's all
Okay,
right.
and I go back. I would. Sorry.
I know. It's all right.
Just poke me next time. Sorry. Okay, so inflation erodes the buying power of a bond over time. So $100,000 investment at 4%, we've already established, equals $4,000 a year. And if you take that $4,000 a year, that's $333 per month, right? So $333, what does that actually buy? Today, it could buy an airline ticket, it could buy sporting events, all kinds of different things it could buy in today's market. So that's the cost of that money, similar to what we demonstrated on the laptop there. So, but as the inflation rises, that $333 may not buy as much in the future. Right? It erodes the buying power of things.
Right.
So 2% here, 2% inflation, which 2% inflation is what the Federal Reserve considers modest inflation. It's manageable inflation. This is what the U.S. government tries to manage to, is 2% inflation per year. Okay, we all complain about, gas prices when they skyrocketed so quickly. It really put a pinch on us. Healthcare,
Right.
this is another big one, right? Healthcare here in the United States went up dramatically, more so than the 2% inflation absorption rate that most people, we kind of get, I don't know,
Accustomed to.
budgeted to, or whatever, right? So, if we take then inflation at just 4%, this slide here is really kind of to demonstrate the power of inflation and how it erodes your dollar.
Okay.
Okay, so at 2% moderation, first year $333 is equal,
Because that's
right?
the bar. That's the bar. Yeah.
Yeah, that's the par. But after 5 years, on year number 6, at 2%, that same money can only buy $301 worth of goods, where at 4%, it can only buy $272 worth of goods.
Well, $272 worth of goods from year one, right? I mean,
Yeah.
it's not like you wrote a check for 272, but it's like the same $333 worth of groceries I bought year one. It would cost me 200. No, wait a minute. No, wait a minute. I'm getting confused.
No, the same.
$272 in year 5 would buy me the same amount of groceries that I paid.
No, it's the exact opposite. So $272 worth of goods, you're not going to be able to buy as much as you
Okay,
would
yeah.
on year one. Okay, you can
Yeah,
only get
with your
$272 worth of
right.
goods. Even though the cost of goods may have gone up, it's equal to $272 at 4% inflation. Okay, and in late year 11, that's where you really start to see a pinch, right? You're $50 a month or thereabouts.
Right.
Right? So, and I just kind of did a little curly Q there to kind of illustrate that. I should have done a
Yep.
sound effect on that.
Yeah, we didn't know. It's the first time
Right.
doing this one. So.
But even at 20 years, I mean, at 21 years, 20 years, it's pretty dramatic, pretty substantial. Really
Right. starts
starts to erode the power of this. So year 11 is kind of what I think, and I highlighted this because based on the readings and things that I've done and the studies I've done, year 11 seems to be what they try to predict in the future. Where are we going to be in year 11? Where are we going to be or after 10 years? And this kind of holds true for, when you look at, presidencies potentially being at 8 years, this is kind of where it kind of falls into play. So these policies and things like that are made, they all tend to try to predict out for 10 years on this.
Why is it so 410 for the cost of the loan?
Well, this means to get the same. Sorry, I should have backed up here a little bit. Thanks for pointing that out. This means that at 2% inflation, year one, $333. That same to get the same amount of goods at 4% inflation, it would take $410 to get the same amount of goods at $333.
Oh, by year 11, by year 10. Okay, I
Yeah,
gotcha.
right, right. Okay. So, so that you can see how then on the bond side of things and how inflation affects it. So what they'll do is they'll raise bond yields to curb that inflation cost, right? That's why it's kind of what Janet Yellen's doing or has done here recently, right? We don't want inflation to get out of control. So therefore we ease into raising the Federal Reserve interest rate. Make sense?
Yes, to me it
Okay.
does. Hopefully, to the people out there watching, it does.
Okay. Hopefully. So now we've kind of said this from the beginning of the year. Rates appear headed modestly in 2017. Although today Janet Yellen, and part of her uh, testimony, I guess, or whatever today about the Federal Reserve, said that they may not. It's more about what she didn't say today, and that wasn't she wasn't committed to raising the rates in September. So markets have reacted pretty favorably
Yeah, because
to
we,
that.
we reported that they said that they'd raise them 3 to 4 times this year. And
Yeah,
we've seen a couple raises, so to not raise in September would be
would be
the
good.
best.
Yeah. That in addition to we've talked about loosening of guidelines and things like that. These are steps to help, I think, encourage. We got a shortage of homes, no question about it. So I think these are all put in place right now, kind of precursor to maybe what next year or January, February, even spring of next year may play out. These policies may help. We know it's a strong real estate policy or a strong real estate market right now, right? We've seen price increases. We've even reported through, I think Redfin or something like that did a study that if interest rates went up, that it wouldn't curb people's appetite to get into the real estate market and purchase homes. So all predictions are real estate is still going to be very, very strong throughout the rest of the year. But I do want to give an example here of a $350,000 mortgage and the impact a rate could have on that. If the rate just went up a 0.5% on that $350,000, that would add just about $100 a month to the mortgage payment. So
That's not bad. Listen,
yeah,
it's not that bad. If
it's
you're
not
if you're
that bad.
spending 350 on a mortgage, you're looking at 2,000 ish, depending on
Yeah.
the product. If you're
Hmm.
doing conventional versus VA or FHA, well, not even FHA because that's too high, but about $100 a month. So you're spending $2,000, $2,100 a month.
Hmm.
Isn't bad if you can afford 2,000 a month. I would think.
Yeah. But over time, that does, it does cost money, and people want the lowest payment possible. Totally get it.
Right.
But it's not that big of a deal, and I think that's why Redfin's, people aren't too concerned about interest rates going up. So that's it. That's the slide.
Half a point.
Half
Wow,
a
look at,
point.
and we just finished 22 minutes. Just started over.
Yeah, yeah.
We
We
haven't
were
said
actually
anything.
went over just a little bit there. I know it was a
Okay.
lot of information in there, so hopefully that was somewhat understandable. Hopefully we kind of put it together for everybody.
Watch it. Write your questions down. Make some notes. Watch it again, or ask Jason to explain it.
Yeah, yeah.
Hopefully
Reach
that
out to
makes
me. I'd love to explain it. That's what I do. That's what I do. So please reach out to me. I'd love to hear from you. And certainly we would love. And sorry, I took the comments off there. I don't know, Mama Shucker
You had to do it
there.
for the slideshow, I think. Yeah.
Yeah, I had to do it for the slideshow, but it may come up now. So, hey, thanks everyone for being a part of the show. Please share with your friends and family. Like our page if you would. That would be awesome. We would appreciate that. And certainly if you're looking to buy, sell, refinance, or invest in property here in Arizona, Phoenix in particular, we would love to be your team of choice. So please reach out to us. I don't know what the MP page is there, honey, but please reach out to us. We'd love to hear from you. So with that, I think we're going to wrap it up. You got any
I know
final?
what it was.
Oh,
Because before you press start on the slideshow, it would be blank.
Oh,
and she didn't want to wait the 5 seconds it took to,
all right.
to get the info. But
All
yes,
right.
thanks everybody. I think we got a lot. I think one of the things I need to do is what do we call it? My squeaky chair. Let's fix this.
Yeah. That's perfect for Halloween, which is coming
Right?
up. It's
Yeah.
right around the corner. Man,
Oh
it's,
yeah.
time's flying. Holy moly. All right, everyone. Have a great day. We look forward to hearing from you very soon. So take care, everyone.
Thanks.
Cue the ending.
Anytime.